On May 22, 2026, Beijing made a decision that should have dominated the front page of every major financial paper in the United States. It did not. China's securities watchdog, the China Securities Regulatory Commission, announced direct enforcement measures against 3 major offshore brokerage firms, Tiger Brokers, Futu Holdings, and Longbridge Securities. These companies had provided mainland Chinese investors with access to American stocks and bonds through offshore accounts. Hundreds of thousands of accounts were involved, billions of dollars in holdings. Within 2 years, that access will disappear completely. Beijing's action was not framed as a warning. It was not a manageable penalty. Regulators ordered the seizure of what they described as illegal profits, both inside China and beyond its borders. A 2-year deadline was imposed for a total shutdown. Effective immediately, these platforms are barred from opening any new mainland investor accounts. Existing customers now have only one permitted path: sell the assets, move the funds back home. Mandatory liquidation, forced selling. That is the order Beijing has now delivered. Meanwhile, the United States Treasury Department continues facing massive borrowing demands. Scott Bessent must secure enormous financing volumes. Treasury filings show that $574 billion was raised during the first quarter of 2026 alone. Primary dealers, the banking institutions supporting Treasury auctions, are projecting a $1.3 trillion funding gap across 2027 and 2028 if auction sizes remain unchanged. To close that hole, Bessent requires permanent buyers. Investors willing to appear at every Treasury auction regardless of yields, inflation data, or instability in the Middle East. For decades, Chinese capital matched that description almost perfectly. Roughly $1.04 trillion in hot money exited China during 2025 alone. Part of that flow moved into United States equities and Treasury debt through offshore brokerage systems, like the firms Beijing has now targeted. That capital acted as a quiet layer of support beneath American financial markets. Washington rarely acknowledged it publicly. Now China has formally ended that channel. The 30-year Treasury bond recently crossed a 5% yield for the first time since 2007. Bond markets are no longer accepting the claim that inflation pressures are temporary. Investors are watching the buyer base contract in real time, and yields are adjusting accordingly. Washington believes it has another solution. Officials are discussing plans for a $3.7 trillion stablecoin market by 2030. The theory is straightforward. Stablecoin issuers would need to maintain reserves in United States dollars, creating another source of Treasury demand. Digital dollar recycling replacing petrodollar recycling. But there is a problem with that strategy. Countries dependent on oil purchases must acquire dollars constantly because energy imports leave them no alternative. That is structural demand. Stablecoin demand works differently. It rises and falls with market sentiment. That demand can disappear overnight during a risk-off shock. You cannot replace 50 years of compulsory dollar demand with a cryptocurrency structure and declare the problem fixed. While officials in Washington continue drafting that strategy, another development has emerged inside the physical gold market. Mainstream financial media has largely ignored its connection to the brokerage crackdown, but the event changes the framework of what may come next. In July of 2026, Hong Kong is expected to introduce the Hong Kong Precious Metals Central Clearing Company. This is a state-owned gold clearing network designed to replicate the system created by the London Bullion Market Association, the institution that has influenced global gold pricing since the 1970s. At present, the London structure processes most of the world's physical gold trading activity, approximately $100 billion per day across combined London and New York transactions. Hong Kong is attempting to capture a substantial share of that volume. To accomplish that goal, Beijing has already taken 3 major steps that should concern retail investors observing from the sidelines. First, the Hong Kong clearing platform will operate through unallocated accounts, identical to the structure used in London. That allows quicker trading, larger transaction capacity, and settlement without physically transporting gold bars. It is the same architecture of market control reproduced in Asia. Second, Hong Kong plans to increase gold storage capacity from 200 tons to more than 2,000 tons over the next 3 years. That represents a 10-fold increase. It also signals ambitions extending far beyond a regional marketplace. Third, Beijing has invited central banks aligned closely with China to join the system at launch. These sovereign reserve managers are seeking a gold market beyond Washington's reach and outside the risk of asset freezes. The board overseeing the new clearing company already includes the Industrial and Commercial Bank of China, HSBC, JP Morgan Chase, and UBS. Those international banks are not participating in a speculative experiment. They are positioning themselves for a future where the center of gold pricing moves eastward. Now consider the actions of the People's Bank of China over the last 18 consecutive months. The PBOC has continued reporting gold purchases without interruption. By April of 2026, official Chinese gold reserves reached 2,322 tons, equal to 9% of total reserves. Analysts from Goldman Sachs, Societe Generale, and the World Gold Council have each indicated that the actual figure is likely much larger. A substantial share of China's gold accumulation reportedly moves through state-owned banks and sovereign channels that never appear on official balance sheets. Estimates for the real total range from 2 times to 10 times higher than the publicly reported amount. Think carefully about what that implies. If China controls the gold clearing structure, establishes the Asian benchmark price, possesses more physical gold than the public understands, and at the same time cuts off the movement of Chinese capital into American equities and bonds, then a closed financial circuit has been created that no longer depends on trust in the United States dollar at any point in the process. That is where the brokerage crackdown connects to the larger picture. Every yuan that previously entered American markets first required conversion into dollars. That exchange process reinforced demand for the dollar. That dollar demand helped support treasury yields. Beijing has now declared that route illegal while constructing an alternative system designed to keep those savings operating within its own financial sphere. Anyone following these developments closely understands what happens when a major buyer leaves an auction. You understand what rising yields signal when governments must attract the next bidder. And you understand that the real danger often exists in the distance between official messaging and the underlying data. This is why independent tracking matters. The important movements are the capital flows, the infrastructure changes, and the policy decisions emerging from Beijing and Hong Kong that many retirement account managers are not discussing with clients. Most people still miss the larger issue in this story. The Hong Kong gold clearing platform is not simply another trading exchange. It represents the final stage of a financial structure Beijing has been building for more than a decade. China already controls payment channels through CIPS, mBridge, and United Nations, swap lines extending across Africa and Southeast Asia. It also holds leverage tied to commodity pricing through relationships involving Iran, Russia, and the Strait of Hormuz. Now another layer is being added, a gold settlement framework capable of allowing countries skeptical of the renminbi to still participate in a non-dollar system through an asset already recognized worldwide. Trust in China is not required to use gold. That is precisely the reason Beijing selected gold rather than the yuan as the foundation of this structure. For American retail investors, the issue is not whether this transition is underway. The numbers already indicate that it is happening. The real question is whether the institutions handling your investments are prepared for a world where the structural demand supporting American assets is smaller than it was 12 months ago and continuing to contract. Earlier reporting also examined how China's record silver imports intersect with disruption in the Strait of Hormuz to create a supply squeeze that futures markets have not fully reflected yet. If you want to continue following these developments, stay connected and keep watching the shifts reshaping the global financial system.